Hi, everyone. I'm David Silver, CEO of Instrumental Wealth. Joining me today is Matt Harbert, Chief Investment Officer. Matt, a ton took place in the second quarter of 2025, and we have a lot to get into today. And so I'll go ahead and turn this over to you, and we'll start off with everything that took place in markets.
Okay, thank you, Dave. We'll start off with the overall broad markets. There actually was quite a bit of volatility overall this year, starting with the tariff fears earlier in the year that led to a correction over the first quarter, with U.S. equity markets falling anywhere between 10 and 15%. Since then, equity markets have had a strong V-shaped recovery. During the second quarter, which you can see on the chart on the left here, emerging markets were the highest performing asset class, coming in at 15.26% over the quarter. And both the US and foreign developed markets were not far behind. The S&P grew at 14.32% in the quarter, and international developed at 12.37%. Also, all major asset classes were positive over the quarter, although U.S. fixed income was only slightly positive at 0.66%. Looking at the table on the right, which is year to date, international markets do still remain well above all of the other asset classes, with international developed on top at 20%. Emerging markets so far this year are at 18.64%, with only U.S. small caps remaining negative for the year. They're at negative 1.43%. So far in 2025, fixed income has been solid as U.S. bonds are up 3.46%, and global bonds are actually very robust. They're up 8.5% this year. Finally, real assets has been a very nice, steady asset class throughout the year. In the first quarter, they were up 3% as equity markets were falling. And during the second quarter, they're up 5.62%. And year to date, they're up over 10.5%. So moving on to the equity markets, the first quarter did actually see some trends starting to develop, some of which continued over the second quarter, while others kind of reverted back to previous trends. One trend that has continued into the second quarter was the softening of the US dollar. As mentioned before, international equities have outpaced all the other markets so far this year. Developed markets up 20%, emerging markets over 18.5%. This is actually, you can see on this chart, it's actually over twice that of the US markets. And the weakening of the dollar has really helped to boost that performance of the international equities. So these charts show the US dollar index. That illustrates the general trend of the dollar versus other currencies. The chart on the left shows the first quarter. You can see in the first quarter is when the dollar started to weaken and fell about 4% over that period. The chart on the right shows the second quarter, and you can see that that drop has continued and has fallen an additional 5.34% since the end of March. So how did that impact the returns to U.S. investors on international investments? On here, it's showing the EFA, which is developed markets, in both the local dollars, which is their markets, and the net return, which is in U.S. markets. And when looking at this, you can see the EFA, which is developed markets, that decline in the dollar has added about a 3% to the returns of emerging markets, and about 5% additional return when looking at developed markets. Also, the recovery has really brought most of our equity markets at or near their all-time highs. The chart on the left shows quarter one. You can see how far off that correction brought these markets off their highs. But the chart on the right is current, And you can see the S&P has actually fully recovered and has even made new highs over the quarter, while international equities haven't quite reached their highest level. They are only about 2% off. Really, the two asset classes that still have some work to do to catch up are US mid-cap equities and US small-cap equities, where mid-caps are still off a little over 4%, and small caps are close to 10% off of their peaks. Moving into the different sectors, there was also a big correction in the tech sector in the first quarter. However, over the second quarter, it did revert back to the top performing sector. If you look at the chart on the left, this shows quarter two. You can see the tech, which is the top one there, has performed 28% over the second quarter. The next closest sector from that was industrials at 18%. So tech actually outperformed its next closest sector by 10%. The defensive sectors of healthcare, utilities, and consumer staples, those led the way over the first quarter, which wasn't surprising. They usually do during times of corrections. But you can see in the second quarter, 2 out of 3 of those sectors were actually negative over that period. So one trend that did reverse from the first quarter was that outperformance of value stocks over growth stocks. Growth stocks really have been the place to be for much of the past 10 years. However, in the first quarter, we did see value outperform. Many out there were predicting that this might be the beginning of a value revival. However, over the second quarter, which you can see on the chart on the right here, growth stocks were once again king. So large cap growth outperformed large cap value by over 16%, while small growth outperformed small value over 5%. So one trend that we were particularly looking out for was a continuation of a broadening out in the index away from the Magnificent Seven stocks and into the remaining 493 companies. The Mag 7, if you look at this over the past few years, has been a major contributor to the strong performance of the S&P 500. You can see on this chart that since January of 2023, the Mag 7 have outperformed the remaining companies 161% to just 34% in the other 300 or other 493 companies. It's a whopping 127% outperformance over that time for those 7 companies. Over the first quarter, the broadening out did appear to be taking place. The Mag 7 underperformed the remaining companies in the S&P by 16%. You can see that on the chart on the left here. But as we move to the chart on the right, you can see that these companies have regained their leadership in the index and over the second quarter have outperformed the remaining companies by nearly 14%. Now, that said, this is year to date. Even though they've had such strong performance over the second quarter, it hasn't been enough quite yet for the Mag 7 companies to overtake the remaining companies in all of 25. However, you can see that they have significantly closed the gap, and we'll see if this strength continues going forward or if we will get back to some broad out here. Lastly, that outperformance of the Mag 7 also reversed what we were seeing in the first quarter. This chart's a little hard to read, but this is the concentration of the top 10 companies in the S&P 500. So it shows what percent those companies make up of the S&P 500. To the right, you can see there was, towards the beginning of the year, there was a significant drop in that concentration level. But since then, you can see after that, there's also a significant spike back up to even higher than it was before. That trend has reversed. That concentration has come back up, and the index is now sitting about 38% in its top 10 companies. And that leads us into the economy, Dave.
Yeah, that what a crazy volatile quarter with equities, and certainly one of the things that I think is super helpful to see is how the weakening dollar has affected international stocks and been a big contributor. So I always appreciate when I see that information from you, and I think it's something that our clients also find really helpful and unique in analyzing that. So yeah, let's jump into the economy. And of course, even more stuff going on in the economy. There's lots going on in the second quarter here. So lots to jump into.
Okay. So far this year, it's been very challenging trying to project the course of the economy. We've had unclear policies around tariffs. We've had a negative first quarter GDP. It was the passing of the One Big Beautiful Bill, as well as the loss of the AAA rating on the US debt. So through all this, how did the economy hold up over the second quarter? We'll start by looking at our usual suspects in inflation and labor, consumption, and Fed policy. So starting with inflation, been quite a bit of concern over inflation heating back up, primarily driven by the tariff and immigration policies. Average tariffs right now are sitting at around 15% on imports into the US. Economists like those at JP Morgan are estimating the amount of the costs that will pass through to US consumers will be about 60%. In addition, the concern around immigration is that mass immigration or mass deportation would lower the supply of labor, therefore increasing wages, which also will lead to higher inflation. However, the effects have not really shown up in the numbers yet. The chart on the left is the CPI, Consumer Price Index, and the chart on the right is the PCE, the Personal Consumption Expenditures. And both of these, you can see, still remain relatively stable and below 3%. Digging into the numbers a little bit more, on this chart, the green shading is where the inflation is lower, while the red is a higher number. So we'll start on the top part of the chart, which is the headline components. You can see kind of in the middle there under energy. This has really been one of the big reasons inflation has been able to stay in check so far. Gasoline in particular has been moderating quite a bit. There was a pickup in June. However, year over year, it is down close to 8.5%. Food prices also have really remained pretty stable, sitting at about that 0.3 to 0.4% month over month. And if we move to the lower part of this chart, that's the core components. And this has really been where the primary concerns have been. And this is also the area that the Fed pays a little bit more attention to. And in here, it really is the shelter area that has been the big challenge, where things have remained sticky and has really prevented this overall inflation from getting down, further to the Fed's target. June for shelter did come down slightly to 0.2%, although that is, while it's on the lower end, it still is in kind of that range it's been over the past year. But year over year, it's moderated down to 3.8%. Now, that is very likely due to some base effects starting last year. Economists, however, do continue to expect that we will see increases in prices as a result of the current policies. But as of now, we haven't seen this materialize. Moving on to the labor market. The labor market has continued to soften, but it's been really a slow normalization. This is important as the US is a consumer-driven economy. And as long as consumers feel comfortable that they will not lose their jobs or that it's not too difficult to find new employment, they should continue to spend. Looking at the charts on the left, the labor market still showing positive signs. Job openings remain well above their longer-term average. Hires are sitting right at their longer-term average, and quits remain elevated. And this really hints that workers are still feeling confident enough to quit their current jobs. And while hiring has decreased some, there's still an elevated level of openings available to those that are looking. Now, I just want to point out, since we put this together, there was a big update in the employment situation report that was released on Friday. The report had big downward revisions of jobs created in May and June, which resulted in a combined 258,000 fewer jobs than previously reported over those 2 months. In addition, the month of July came in quite a bit lower than expected, with only 73,000 new jobs compared to the 110,000 expected. As expected, the employment rate did increase. You don't see it on this chart because this was also part of that report that just came out. But the latest reading, it did elevate slightly from 4.1% up to 4.2%. And while this is above the lows we have seen, it does still remain lower than the longer term average of 4.61%. Also looking at the number of jobs available to those that are looking for work is also very similar to the labor market, has been declining. However, over the last year, it's pretty much been pretty stable, and they're currently just over one job available for every job seeker. So overall, the labor market is still fairly positive. In addition, the immigration policies, while potentially inflationary, could have positive effects on employment. If the labor pool shrinks, there are more jobs available for the remaining workers. This also may increase wages. So both of these impacts could support additional spending. Looking at consumption, spending has been sort of oscillating around its monthly average over the past couple of years. Although you can see on these two charts, the top is retail sales, the bottom is the broader number of personal spending. But both of those, you can see that those movements we've seen bigger swings in those movements more recently. The retail sales number, which is the top chart, was drastically negative in May, but has since had a nice pop up in June, exceeding the average monthly sales. Similar story in the bottom chart and personal spending. Things have reacted much more intensely lately. There was a sharp decline in May and a similar rebound in June. However, unlike retail sales, the June number hasn't quite reached its monthly average, but it's very close. So all in all, personal spending isn't spectacular. However, it does remain positive. So there's nothing here that really appears to be alarming. That brings us to the Fed. The Fed has been on pause all year, keeping rates at the 4.25% to the 4.5% target. Expectations coming into the year that we might see 4 or 5 rate cuts. However, the Fed's fears of fiscal policies driving inflation up put them into a wait and see mode. Prior to the release of the employment situation report that we just talked about, expectations were that a cut would not occur until either the October or December meeting this year. However, with such poor employment numbers that came in, this does add concerns that the economy is not quite as strong as previously expected, and this could force the Fed to prioritize the employment side of the mandate over pricing and lead them to cutting sooner rather than later. These are the dot plots that was released in June. This shows how the Fed members, where they think rates should be. So if you look, shows each of the years. The column to the left is 2025. The dots that are in blue, that's the median level. So where in general the Fed believes rates should be. And for 2025, that puts us about 3.9%, which would really only hint at one more cut, maybe two this year. Also interesting to note, the column all the way to the right is the long term. So where they expect, after 2027, rates would kind of fall in for the long term. That sits at 3%. So really that implies we'd only really have 25 basis point cuts over the next 3 years to get to that level. What are the markets kind of pricing in as far as a rate cut in September? I left this chart in here. I thought it was interesting to see. This was just before that employment situation report came out. And in this point, the September meeting, the markets were really pricing in only about a 40% chance of a rate cut. Now, moving on to the employment report coming out, this is how things were being priced into the markets. And you can see there was a drastic swing from only a 40% probability to close to a 90% probability that the Fed will cut rates in September. So at least as far as the markets are thinking, it's looking likely that we will see potentially a cut coming up in September. That brings us to GDP. So we did get the advanced report for the second quarter growth of the economy. We did have a nice rebound over the second quarter. So you can see in the first quarter, which is the second column from the right, we actually had a pretty bad quarter, came in negative 0.5% over that first quarter. Now, a big driver of this, you can see down a little bit under imports. That really drove a lot of this. So maybe there was an overreaction to tariff fears that, a lot of imports came in as they were concerned where costs may go going forward. This led to a pretty big inventory buildup. And if you look to the column to the right of that, you can see almost as much of a negative number there. So it looks like that kind of reversed in the second quarter, which resulted in kind of a whiplash in the other direction. But the number that really is more important here is that personal consumption expenditures number. Again, looking at that first quarter 25 column, it's that second row of shaded numbers, of colored numbers. You can see it in the first quarter, consumption only came in at 0.5%. And if you compare that to the quarters previous, you can see we were somewhere around 3 to 4% previously, and that fell all the way down to just 0.5%. I mean, as we mentioned before, the U.S. is a consumption-based economy, so that's a big driver of the success of growth of our GDP. But we did see in the second quarter that did rebound a bit. It's moved up to 1.5%. So not quite as strong as we saw back in 2024. So it's a little bit underwhelming, but it is nice to see that it has become positive again, a nice pop up from that 0.5% we saw over the second quarter. And overall GDP came in at 3%, which is actually a pretty strong number for the overall number. This chart actually is something Fidelity puts out, and this is their estimate of where the U.S. economy is in the business cycle. And you'll see it has quarter two. That actually is, that dot is overlapping a few other quarters. So we've pretty much sat in the early part of the late stage for about the last year. But this quarter, they've actually pushed us forward. So you can see that Q3 dot on here, where Fidelity is estimating we've now moved a little bit closer to the end of the late stage cycle. Not quite in recession yet, still a little bit more to go, but we are getting a little bit closer as far as their predictions go.
Matt, that was a lot of data, and I know for you and your team on the research side, just so much back and forth last quarter. It probably was making everyone's head spin quite a bit. I think the probably most interesting data point from the previous slide was around how drastic of a swing there was in imports. You saw really everybody rushing to buy everything from automobiles to whatever appliances that they needed to buy in preparation for the tariffs that were coming, and just a wild drop off in the second quarter there. It'll be interesting to see how that sort of smoothens out here as these deals come through and ultimately the tariff revenue starts coming in as people have a little bit more clarity and ultimately confidence with things. It'll be really interesting to pay attention to. But certainly the consumer seems to be feeling more positive about it and seeing that consumer spending and expenditures increase is certainly a positive sign going forward. So economic events. So even more to get into here with everything that took place. So I'll turn it back over to you for this part.
Okay. We did reference this a little bit, but there were a couple of events that occurred over the past few months. One of those was the US losing their final AAA rating. And the other is the passage of the One Big Beautiful Bill by the Trump administration. So as far as the US losing their AAA rating, there are three major rating agencies: S&P, Fitch, and Moody's. S&P actually dropped the rating back on August 5th of 2011. Fitch dropped their rating back in August of 2023. And so we've been sort of holding on to that last pristine rating from Moody's, but in May 16th of this year, they did drop us as well. They were the last holdout. This year, they dropped us off of that. So it now means that the US is no longer rated at the highest quality level with any of the major agencies. And this is the first time that this has ever occurred. The reasons given by Moody's for this action was similar to what we heard from both of the other two agencies at the time they made their change. What they quoted was persistent large fiscal deficits, growing interest costs without any credible plan to address them, political gridlock, and a potential extension of the 2017 tax code. This chart actually shows kind of where those costs on the deficit are, touches on the ability to pay the interest, currently sitting around 1 trillion. On this chart, the blue part of these bars is kind of the baseline from the CRFB that is projecting this out. So just baseline, you can see that they're expecting these to grow fairly significantly up until 2034. However, there's a couple other pieces to this. The red part of these bars is assuming that interest rates will stay around kind of the 4.5%. And then the green is additional increases, assuming that the 2017 tax code gets extended. So currently we're sitting at about 1 trillion, but they have projected, given all of this, that by 2034, that could rise all the way up to 2.7 trillion. And both, as you can see on here, the extension of the tax cuts as well as higher interest rates could have a fairly big impact on those numbers. But how did the markets react to the loss of the AAA rating? The chart on the right shows the 10-year treasuries. It did rise a little bit initially, but it's since come back down and it's kind of stabilized around that 4.25% to 4.5% range. Also looking at the chart on the left, that's the S&P 500. The stock market reacted fairly similar, had an initial sell-off, which you can see to the left of the chart there, but since then has really just taken off and risen pretty significantly. In the short term, really the markets pretty much mostly shrug this news off. The concern is really more in the longer term, like how this is going to impact things with higher borrowing costs and even just the safe haven image of the US over that longer term. We did actually put a piece out that discusses this AAA rating loss. So if you're interested, you can reach out and see that as well, where we dig a little bit deeper into this. So the One Big Beautiful Bill was signed into law by President Trump on July 4th. The bill was wide-reaching, but some of the key provisions are the 2017 tax cuts were made permanent. There was an increase in funding and resources for immigration control, tighter restrictions on Medicaid funding. It's going to be a phasing out of the clean energy provisions, tighter eligibilities for food stamps, and more controls and restrictions on student loans. So it's a bit early to know exactly, but some projections on how this bill will impact the economy are a potential short-term boost to GDP from both infrastructure and energy investments, a boost in manufacturing from incentives and repatriation policies, a slowdown in a transition to green energy, increased deficits, maybe higher interest rates for longer, could see positive impacts to the equity markets from pro-growth policies, and negative impacts to bond markets from larger deficits and higher inflation. And that's what we saw as far as the key events so far this year.
So Matt, thank you for everything that you and your team did to prepare this information. And I know our clients love these quarterly updates because there's so much great data that you put together for everybody. So thank you. A lot of takeaways here. I think the first being, if you went into hibernation on April 1st and woke up on July 1st, you would have missed a whole heck of a lot of stuff and missed this enormous V-shaped recovery that we saw starting towards the end of April as Liberation Day had come forth, and the volatility with equities and bonds alike would have been certainly an interesting way to have missed the second quarter and all of the events that took place. At the beginning of the year, I think we thought maybe the concentration risk of the Mag 7 was over and that run was done. Back for now, I think, is the theme there with the Mag 7. We'll see what happens here in the second half of the year and certainly Q3, but certainly a nice recovery there from the Mag 7. Looked like there was going to be a start of a trend, TBD. Diversification matters more than ever. I think for the last sort of decade, we've seen U.S. large cap just completely outperform most asset classes. And certainly on my end of the house, talking to clients about diversification and why it matters, I think was paramount in the first half of the year, particularly with the huge disparity in returns between international, both on the developed and emerging market side of the house. And so diversification matters even more than ever. The employment situation, TBD, right? I think there's a lot of mixed news out there on this matter, and I think we'll see if how far off the reporting was as we get some clarity on that, on who's going to lead that area going forward, as well as the deficit. I think with the one big beautiful bill and the loss of the AAA rating from the last rating agency, I know you wrote a great piece on that recently, but we'll see what happens with deficits. And I know that the Trump administration has criticized some of the calculations by the CBO and not counting tariff revenue in their calculations, and really from their perspective underscoring the GDP growth as what that budget forecast would be. Both of those would certainly be a positive step in the right direction there with the budget deficit if growth continues to come in higher than expected and the tariff revenue continues to come in. And if the surplus that we saw in June with the Treasury continues, that'll certainly be a positive there. And of course, what sort of growth we see with the tax and deregulation that takes place with some of the other aspects of the one big beautiful bill. So Matt, as always, thank you for your insights, your commentary, the overview, the explanation. Super helpful as always. And if you're watching this video as a client or a prospective client of our firms, if you have questions for any one of us here at the firm, don't hesitate to reach out to your advisor. We'd love to have a deeper conversation with you around any of the topics covered in this material or any other questions that you might have. So once again, Matt, thank you. And to our clients, we look forward to a deeper conversation with you one-on-one. Have a great day, everybody.